it's about 14.5 billion for for-purpose organisations.
Luckily, there's some great people like yourselves who are willing to sit in those seats as board members. We just need more of them.
Are boards too conservative when it comes to investing?
Within senior living, I think you need to be. What we're trying to say is it's a lever that you can take advantage of. When you're ready, let's have that conversation.
We're the stewards of the final days of many Australians' lives.
At that tail end of my life, I still want to be part of a community, or I'm bringing that community with me.
Welcome to Time Well Spent, the podcast for decision makers, providers, and everyone working to make a difference in care. I'm Dane Mitchell, joined by my co-host, Rose Plater.
Together, we bring 31 years of combined experience and still counting, and a shared passion for reimagining aged care and community health. From policy and reform to leadership, culture, and connection, this is where we explore new ideas, hear what leaders really think, and uncover what it takes to create environments where time is truly well spent.
The information in this podcast is general in nature and doesn't take into account your personal objectives, financial situation, or needs. Before acting on any information, consider whether it's appropriate to your circumstances and seek professional advice.
Joining us today are Anthony Hamawi and David Hurley from JBWere. Anthony is a director at JBWere, where he works with boards, charities, and not-for-profits to align their investment strategies with long-term purpose and sustainable investment returns whilst managing compliance.
Alongside him is Dave Hurley, a director at JBWere. Working closely with Anthony, they support aged care providers and institutions in the not-for-profit space with risk management and maximising return for investment. Today we ask Anthony and David to bring a different perspective on what might normally be a very dry, nerdy discussion. We ask them to think about their own ageing journeys and what they would change.
Dave, Hammer, welcome to Time Well Spent.
Thank you.
Thanks for having us, guys.
So you're both at JBWere, both directors at JBWere. Who is JBWere, and what is your relationship, I guess, to the aged care or the full purpose sector?
JBWere is 185 years old and has managed money for a very, very long time, and has now become a house that manages over 65 billion under management. And within my space and David Hurley's space, it's about 14.5 billion for for-purpose organisations, of which about 1.5 billion is senior living. I'm a director within the philanthropic services team. And what that means is of the 700 clients that JBWere manages and the 14.5 billion for for-purpose organisations, we focus first and foremost on governance, ESG requirements, liquidity requirements, investment management policy requirements before it goes to the advisor who manages the funds and the day-to-day movement of the portfolio.
So Dave, your role's managing the money effectively.
Yes, that's right. So I see my role as make sure I understand the client really well, or the organisation, and being able to kind of craft a policy or an investment management strategy that really works within, their particular set of circumstances. And then I suppose the implementation part is, what companies do we want to invest in? What bonds do we want to select? What fund managers might we use? So it's really understanding that piece, and I guess bringing all the JBWere capability. So a 40-person investment research team sits behind me.
So basically, your role is to understand what the individual provider wants to achieve, and then
That's
you work
right.
with your 40-person investment team to find the best investment options for that.
That's right. Bring it all together and deliver something that's hopefully very tailored. So it's not, there's not a product suite where we're sort of picking off the shelf. It's very much, built from the ground up for each and every client.
How do you find the balance between risk or safety of the money that a provider holds, but also returns? And just to added context too, Dave, both Rose and I are board members, and that word risk is something that a lot of board members that maybe aren't finance people like us are not as comfortable with as you guys are who do it professionally. So how do you manage that?
Yeah, I think it comes back to what Rose said earlier around you have to have a really good understanding of your cash flows first and foremost, because if you don't really understand what your drawdown requirement might be or what your capital expenditure requirements might be, it's really difficult to then make informed investment decisions. So get that right first. So the best providers, have really gone granular and kind of understand that, they've got good occupancy. They know they're going to get a RAD goes out, another one will come in. We're always really conservative around whatever assumptions we make. We provide a good buffer there. So you've got your liquidity requirements that are mandated anyway, but we might even be sort of more cautious than what we need to be just to give providers comfort in the first instance. And then maybe it's worth just touching on the different types of assets that we invest in just to kind of demystify this space a little bit. So for a lot of seniors living providers, it might be as simple as a bond portfolio. So most people are familiar with term deposits. You can invest for, say, a 12-month term deposit. You might get sort of something around the 4% marker at the moment. But if you're looking to, I suppose, just increase your return profile marginally without taking on too much risk, and when we talk about risk, we're really talking about things like, volatility. So how much is the actual price of the asset that you buy likely to move up or down in the short term? With credit or bonds, there's risks like default. So is there any risk that this company might not give my money back at the end?
For an aged care provider though, like how do you manage those risks? Are they big companies?
Yeah, so generally for an aged care provider, it will be, high quality corporate credit. So think of, big Australian banks, so senior secured debt. And then we're really looking to blend portfolios. So the way you sort of manage risk generally is through diversification. And so that's in the context of a bond portfolio, it might mean buying, a number of different bonds, so that if one bond doesn't perform as well as you hoped, it's only a small portion of your overall portfolio. And then for providers that can take a longer term view, so once you're starting to look at sort of 5+ year investment horizons, then you're bringing in things like equities, so Australian shares, international shares, real estate, alternative assets, so things like infrastructure investments, private debt, private credit. And it's all about blending those assets in a way that gives you the best possible risk-adjusted return. And that can be by investing in high-quality companies. So JBWere is a very conservative asset manager. So generally, companies that we invest in will be high-quality companies. We're trying to pay a reasonable price for those companies. So all those typical investment themes that you've probably heard. And then we take sort of tactical views. So for example, we might see that markets are perhaps looking expensive overall. And so we might be tactically underweight US equities, or we might be more defensively positioned relative to positions in growth assets for clients. But I suppose at the higher level, we believe strategic asset allocation, so the mix of the assets that you choose, is the main driver of long-term returns. So it's getting that right at the start, and then the rest is sort of, I suppose, at the margins then, because the client understands that the way they've invested will deliver an outcome.
JBWere's philosophy is very much the preservation of the capital first and foremost, and then the potential growth of that. So the preservation makes us a conservative house. We'll protect that to the best of our ability as our highest priority, and then look for growth and value investments. The two free gifts that you get in investing are diversity, and that's the power of the different asset classes that David's mentioned, but also duration. And so the duration element that David also referenced in terms of 5+ year investments dictates different pooling mechanisms and best practice that through the years of practice that we've established, we can sort of say, well, based on your scenario here, we would suggest 2 separate pools. And we largely base that on what the CPI expectations are of the organization, what sort of risk appetite they're willing to take based on some guidance that we can provide as well. So everything that we do starts from a level of governance, and then we hone into sort of the detail of how that might look and the pooling mechanisms. But you've got duration, diversity as real key elements that protect the downside.
Effectively, what you're saying, to put it in simple language that I can understand, is that by having diverse investments across asset classes, you can protect the capital, but at the same time still get an above inflation or a market rate of return without as high a risk.
Yeah, and we should say this is all general advice. So we need to, every provider or organization will be different, and some providers might be best placed just to hold cash and term deposits, for example. Others are in a position to look at and explore these other asset classes.
Would that largely depend on, say, their operating profit or loss in their business?
Yeah, operating situation. So yeah, how profitable they are, but also what does that balance sheet look like as well, and do they have a corpus or a pool of cash or assets that they're comfortable they can take a longer term view with, and that's the biggest thing when you're looking at investments beyond cash and term deposits and even bonds. You need to have the time to stay invested through market cycles as they move up and down. I guess to bring it back to your question on balancing risk and return, often there's a conversation of, what sort of return are you looking for? And then it's probably, I want a great return and I don't want to take any risk. And then we have to kind of work out where's that happy median in the middle to sort of go, okay, well, we can't give you that return unless we sort of invest in this fashion, but with that would come a reasonable level of risk. And then we sort of find our way to a happy middle ground.
Are boards too conservative when it comes to investing?
They should be. Everyone's quite harsh on boards, just on a general basis. But within senior living, I think you need to be. There's the refundable element of what they have to do. There's the clinical element of what they have to do. There's the legislation is a lot, and that creates fatigue. Their responsibility is just huge, and their priority will never, ever be the investment management of excess cash. That's never, ever going to be their priority. So we understand that from an investment house. What we're trying to say is it's a lever that you can take advantage of when you're ready. Let's have that conversation. But boards, with the level of responsibility that they are currently taking and their philanthropic nature of actually giving back to a community, whatever that might be, whether it's a regional community or even a metro community, you're helping vulnerable older Australians at the tail end of their life. It's a mammoth responsibility, and therefore it should always be treated conservatively. I think anyone that assumes otherwise, I'd go to
take them on.
Yeah.
And in terms of governance, this is incredibly complex, changing. I've been involved in the sector for almost 2 decades now. And if I think about when I first started, owners probably wasn't on the board or weren't aware of the responsibilities. Do you think that we have it right now?
I feel like it's always evolving, right? It'll continue to upskill boards. I think the focus on skilled boards is positive, but it's actually getting the right people to want to take on that responsibility. So it's a balancing act. So this sector needs to become more attractive, I guess, to bring in more and more great people who want to get involved. I think luckily there's some great people like yourselves who are willing to sit in those seats as board members. We just need more of them. And yeah, you need that diversity of skills on the board so that, you do have someone who, understands the clinical side, understands the financial aspects of the organization, the legal aspects, all those things that come together to make a good board.
Just an observation that I've really noticed over the years as well, sort of being in this sector for a while, is that the green shoots are creating a bit of positivity. And I think that's really important because you go day in, day out, working your bottom off, and you feel like you're not really getting anywhere. You're consistently being scrutinized. You're on the magnifying glass all the time. Finally, there feels like there's some positivity, a new legislation. Government's taking senior living seriously. There is a really big influx of boomers that are getting to that stage of life, so it's important. And we referred to John McLeod before, but he's just recently done the Bequest Report, which talks about one of the biggest intergenerational wealth distributions of all time and what that actually means for society. We really need to understand that there's real positivity, there's energy, and we need that excitement to infiltrate to providers.
I think that's a big part of our reason for starting a podcast too, is that for a long time, aged care's copped a bad rap. News stories are negative, the TV stories are negative. There's a lot of really smart switched on people trying to make a difference. And I think we don't get the positive publicity that the industry deserves.
Yeah, it's a great privilege to be, I guess, a part of a sector that is, we've discussed is the steward of the last years of many people's lives in Australia. And I think it's great to have passionate people like yourselves in the sector. And I think we need to keep the good talk going. In terms of, I guess, governance, there has been discussion around boards should be paid, not paid. Food for thought.
Yeah, I mean,
Tell us what you really think.
I think if you want to attract talent, then paying board members is going to help with that theme, right? So if you're asking for volunteer boards and you're, with the ever increasing responsibility that sort of weighs on board members, naturally that's a lot to ask of people. So I think paying board members makes sense.
Yeah, and I don't think it's ever going to be at a commercial rate, but it's acknowledgement of thank you for your effort and thank you for the responsibility that you're actually taking to be on this board. I've done the AICD course. Being a director or board member, you do carry a lot of personal risk. And so you should be rewarded to an extent. But I preface everything with it depends. And there are some organizations that just can't afford that at the moment. And I think we just have to be conscious of, yes, it's important to reward and recognize individuals that are sacrificing time, effort, expertise on a non-commercial basis on boards, but also acknowledge that that might not always be a possibility for all organizations.
And with all the changes on the 1st of November, what do you think, I guess, are the high level things that boards need to be checking if they're not a client of yours already, which I'm sure you're stewarding them beautifully through?
Just prefacing that all this conversation is general advice. So when we work with clients, we very much need to understand the particular circumstances. So all comments today, please don't take these as personal advice or any sort of specific advice for your organisation. The biggest thing off the bat is make sure you've had a look at your LMS and IMS, so liquidity management strategy and investment management strategy.
Do you want to just expand on those a little bit for some of the less educated like myself?
So liquidity management strategy, I guess, as it sounds, is, I guess, governing your liquidity requirements. And, that is somewhat legislated, but also your organisation might have a particular way they've sort of looked to frame how much liquidity they feel they need to hold. And then your investment management strategy is, I guess, what allows you to make investment decisions beyond cash and term deposits. And effectively, it's a governance document that talks about how you're investing your funds and why. So it might be that you're looking at investments in bonds, equities, real estate, all of those things. So it's sort of your investments beyond your LMS, and it should speak to your LMS as well. So the two documents kind of work in tandem. I don't know if you want to add anything.
The only thing that I would add is the difference between C-suite and the board within senior living, and the requirements of each might be different. So from a C-suite perspective, in terms of CEO, CFO, COO, they are very into the daily practice of the operational side of an aged care facility, and that's demanding. That's got people's lives in their hands, got family members, it's got paying your staff, nurses, managing minutes. And then they also have to focus on the finances, the accounting, the operating costs, the capital expansion. When a resident moves on, the refurbishment of that property, that house, that room, as an example. So their job is very continual and very busy, and just based on the influx or lack thereof of government funding, it has been a very demanding job for the industry as a whole. So they are very occupied in their day-to-day practice of running a aged care facility or retirement living or home care operation, whatever it might be. But from a board's perspective, they set the strategy, and they need governance to really be the essence of how they operate. And that's what we're really noticing with the Aged Care Commission, really focusing on, have you got the right governance in place to manage the magnitude and the multifacets that you need to be all over. And that's part of the reason why there's a push at the moment for skilled board members. There's an argument at the moment around paying board members. It's been a community-based driven operation for a while, and they're trying to uplift the sophistication because of that responsibility. But what we're really noticing with the legislation is the governance element is becoming very, very important. And when we talk about liquidity requirements, it's not that people don't have cash flow and people don't have a reserve of money. It's making sure it's set aside for the worst case scenario. That's what the Commission really wants us to be all over when we focus in on this industry. And so that's where JBWere starts with. They focus on the governance elements. Liquidity is an incredibly important component, and the investment management policy sets out with what's remaining here, and we've taken into consideration your operating costs and your capital expenditure. What's left? How can we support you to potentially alleviate some of that operating costs that you face? And what parameters can we work to when it's outside of cash and term deposits?
What you're talking about there really is the RADs, right? The refundable accommodation deposits.
Can be a number of things, because obviously a lot of the seniors living players in this space are really diversified not-for-profit organisations operating in, retirement living, perhaps disability, housing, all sorts. So in certain situations, it is predominantly a RAD pool that we're talking about, refundable accommodation deposits. In others, it might be, more of a diversified mix of sort of assets or cash that they've built up over time.
Retained profits.
Retained earnings, profits, retirement ILUs. I guess to answer your question before that we dodged shade over, what we're doing with our clients at the moment is just reviewing those policies. So those IMSs, LMSs, making sure that they are in line with the new changes. So I would say most providers are pretty aware, obviously, of these changes coming through and are looking to make sure that they're complying with the changes. Still a lot of talk around whether this is kind of where we'll land, and push back from different consultants in the space that are far more qualified to talk about this than us, like the Stuart Browns of the world, who are offering their views on the best way to perhaps tweak these changes. But suffice to say, I guess we just want to make sure our clients are aware of it. If they need to make changes to their policy, that we're viewing those. In a lot of cases, clients might have been conservative already, and the liquidity requirements are well within range, and in others there might be a need to sort of review those and consider things. And maybe just to, I guess, round out that liquidity conversation from the way we think about it, there's a difference between, I guess, liquidity and volatility. And so we're really conscious of, when we're investing for clients, that they understand, which of their investments can be liquidated if they need to. So perhaps the stock market is a good example of, you wouldn't want to be taking a short-term view with equity investments, because obviously we all understand that they can be quite volatile in the short term, but you can liquidate direct shares in T+2 business days versus perhaps, an infrastructure investment that, is a much more longer dated investment. So it's understanding what your liquidity requirements are and making sure that you kind of, across your portfolio, we've taken that into account.
And in terms of the for-purpose space, are you finding that the mandated liquidity standard is generally lower, less conservative than what a lot of the liquidity standards are, and how are boards reacting to that?
Not all for-purpose organisations have a liquidity requirement that's legislated. Senior living does, and the reason for that is when we look at refundable deposits, there's an obligation that's backed by the government that money will go back to the family once that resident passes. So there is an extra layer of obligation to the provider that the government has given them that responsibility. And because the government's given them that responsibility, they are protecting themselves for people that might struggle to repay that. And there's been stories and case studies where that sometimes happens. So this is within the for-purpose remit. Not every segment has a liquidity requirement that's legislated. Mm-hmm. So we are working to what are parameters are within this space.
Yes.
I think just to round that out, a lot of the smaller players probably have been quite conservative historically, and so perhaps are not all that worried about the changes. It's probably some of the larger providers that have been somewhat more aggressive in perhaps how much liquidity they've chosen to hold, because they have a really sophisticated kind of understanding of their cash flows and how they're looking to invest. So it is a little bit
So do you see difference
disjointed.
in the way that bigger providers manage their money versus, say, smaller community not-for-profits?
Yeah, certainly. I guess the larger providers are all generally working with an investment manager, I would say, as a generalization, whereas perhaps some of the smaller providers, particularly understandably where there's been sort of profitability challenges, that's, I think, where it's been more difficult for them to make a decision around moving away from cash and term deposits.
And I might just double down on that. Dave mentioned earlier the power and impact an organisation like Stuart Brown has had on the industry, but his benchmarking survey informs the government, and Grant Calderoy was on the task force. And so the argument that's been going on for a very, very long time is organisations on a general basis don't actually have a liquidity problem. That they actually have a fair bit of cash there for, the RADs that they've held, etc. What they do have a problem with is sustaining the operating costs and therefore their profitability. And that's been the Achilles heel for senior living for a very, very long time. So I think we're very fortunate from an investment house that it's the groups like Stuart Brown that's been able to inform and educate the government in terms of some of the pain points that, based on the benchmarking surveys they've done for such a long time, that's given us the benefit of the doubt to start managing some of those funds and to alleviate the operating costs that they experience. Everyone's familiar with inflation. We did a presentation for Aging Australia last year where we just spoke about the price of milk and what's happened over the last year, let alone petrol prices and all the other costs that are involved with wages and workplace shortages and going through agencies and everything else that makes it so hard to actually operate when you've got a pool of money on the other side that's, we call it like lazy cash. We've reaped the benefit of Stuart Brown being a real loud advocate and having a spot within the senior living or aged care tent in government that's helped us now see a new Aged Care Act come out that really benefits and revolutionises where we are.
So effectively, Hammer, what you're encouraging is the providers to use that money to get the best investment return they can?
It depends. Ideally, there would be some excess because we've gone through the governance elements to see what your operating costs are, what your capital expenditure is, and there is some left over. That is the best case scenario. Big players have really focused in on that. Smaller players are hesitant and it can be a slower discussion. But when the timing is right, that is a conversation that we would certainly have with them to explore. And if there is an opportunity, then yes, by all means. But we certainly won't assume that to all providers.
In terms of the retirement living funds now coming into play for under the Aged Care Act, have you got any thoughts around the legitimacy of that federal legislation playing in the state space, and any particular states that you find more interesting than others at the moment in that space?
Oh, that's a hard one. You could look at it a few different ways. It's, I think, a lot of capital obviously getting attracted into the retirement living space because the profitability perhaps looks better than in the RAC space. But I think as far as the, comment on the legislation and whether it's a good idea, look, I'm not sure, to be honest. I think it'll be interesting to see how that comes together. Obviously, I think we need to be careful of making sure we're still investing in, the typical aged care operations as well. We know we've got a supply issue around beds coming up. So I'd just be saying, are we incentivizing organizations in the right way, especially in that for-purpose space? Because ultimately we need to make sure we're still providing beds in aged care. And then, where that lands, I guess we'll see.
Do you think there's enough investment into the aged care home space to meet the demand of the boomers coming into that part of their life?
I think probably not right now is the feeling, and you guys probably can all share your views on that as well. But I think we will have an issue there if we don't start seeing more investment. And there's been sort of some challenges around, drawing capital into the space. But I think there are some green shoots perhaps around seeing, I guess development costs start to become a bit more manageable. I think the banks are starting to get a little bit more appetite to support aged care as well. And so there's I guess growing interest in those sorts of players that perhaps didn't want to touch the sector for a period of time and now kind of coming back to the party. And then that's, naturally if there's finance or if there's capital available, that encourages development.
So you're seeing from your clients more interest in investing in capital works now?
I think so. Yeah. I think, every organization again is different. So some are still just focused on, as Hammer touched on, they've got operational challenges and, they've got other priorities and we're obviously seeing the consolidation continue in the sector. So we'll see, more and more of those sort of transactions taking place. But I think, broadly speaking, I will hope that we will see continued kind of development starting to happen.
Maybe also just in continuation to your particular question, and from my perspective, really spending a lot of time in this sector to learn it and to see why and how the legislation's been rolled out. What we have noticed for a very long period of time is a very large focus of in-home care. Whilst that's really positive for families to stay in their home for longer, that does have effect on other organisations and other providers such as retirement living and such as aged care. What we are noticing is over that period before this new act, there was a real sense of consolidation. And so the bigger players were acquiring more. And basically those bigger houses have now become beasts that are trying to use economies of scale to reduce their operating costs and serve older Australians better for longer. But the in-home care packages that are continually being released and revised, and as part of the new legislation, there's been a rollout of 20,000 more in-home sort of care packages recently. What that also means is that people are going to aged care later in life and they're older with issues that are expensive and need extra time to care for. And so that is where it's a bit of a balancing act between new legislation coming in, new policy, the fatigue of continually changing your processes and keeping up to date with new legislation, whilst also understanding the strategy that the government's going for to look after older Australians.
If you're advising government or even a board about, a couple of changes that would make aged care operational costs more sustainable, what would they be?
Oh, geez, Dave.
I think the big obvious one is user pays model, right? Like I think you're going to have people paying more for their share of care. So
do you think that should be everyone, or do you think there can be a tiered system?
I think like everything in this space, you've obviously got your means testing approach to make sure you're protecting the vulnerable parts of the community so that they, you've got to make sure everyone has access to the care that they need. And then if you can afford it, you treat it much the same as you would, throughout the rest of your life, where you have to pay for, the support or the rent or the whatever housing you're looking to live in. Certainly the people that we talk to in the private client world that can afford it are almost moving in that direction anyway. They want to live in places that they like. They want to live in a retirement home or an aged care home that has all the amenities and things that they want to have around them. And so I think providers are aware of that as well. So you'll have these different players in the market targeting different market segments. And so there'll be that opportunity to sort of pay for more higher end care if you want it. And there should still be, and particularly those for-purpose providers hopefully will come in and wrap around those more vulnerable individuals in our community.
And in terms of your clients and obviously looking through and you partner very closely with them around cash flows and in discussion with your investment strategy, etc. Do you think that we're, as a sector, being brave enough to actually differentiate our product, or are we still pretty vanilla from one to the next?
Yeah, I think there's some people doing some really innovative and interesting things in the space, but yeah, certainly they're probably the exception rather than the rule. There is a big sort of body of work there to say that how do you bring some of these older assets into the new world, make them more sort of fit for purpose for what all these boomers that are sort of entering the market in the years ahead. We had a session yesterday where we had John McLeod from our philanthropic services team talking about some themes around basically the massive increase in deaths that we're going to see in the coming years, which sounds a bit morbid, but really it's about the fact that these boomers are now moving into this phase, and there is a lot of them. They're demanding. It's not like the previous generation who, perhaps were pretty frugal and happy to sort of live in different types of accommodation. I think there will be a need to, if you want to target these consumers, that you do spend some money to uplift.
Can I share a mega nerd fact about death under the aged care? So structurally, I'm not sure if you're aware, but the last day a resident is in care is an unpaid day. An exit in terms of the current Aged Care Act is deemed the same, whether you're leaving to move to another provider or if you're passing away. So I think there's a whole structural blindness to death and dying in the sector that we really need to be a part of discussing more openly that subject. In aged care, we are the stewards, whether it's in retirement, home care, or residential aged care, we're the stewards of the final days of many Australians' lives.
Yeah.
And there are so many kind of hidden facts that structurally we're not really supporting a good death in Australia.
Yeah, it's a great point.
There's a regulation piece too there, Rose, that probably needs to be looked at from what you're saying.
Yeah, well, even the word death. We don't actually, very few aged care providers actually record a resident's place of choice around death. In the palliative care space for paediatric patients, that's a really important question, or younger clients living in the community is, do you want to die at home? What does home look like? Where in residential aged care, there is such a burden on nursing and on the staff around compliance that I think structurally we're not supporting a good death, that we're not talking about, those final choices. And so many clients are passing away in hospitals because the registered nurse is concerned about deterioration and the effect of complaints, etc. So I think it's something that we can all do, I think, as participants in the sector, is really call it out. It's a very, real thing in everyone's lives at some point.
Yeah, absolutely. And the challenge of balancing, I suppose, compliance with, still having having a heart in terms of these, these are people, and we want to still be able to have that high touch, positive experience.
Yeah.
And one of the challenges I think within aged care is, there's staff that are dealing with these residents on a daily basis, but a family can be quite large. When a person is going into aged care, potentially with something like dementia, and your children who are, in their mid-50s, early 60s, having an opinion, trying to showcase the love that their parents gave them and wanting to do the best thing for them, it can sometimes come across as an aggressive approach to the provider in terms of, no, you're not doing the best thing for my parents and you're not helping them through this transition in their life. And this is the final stage of their life. So I need you to focus in on it. It's a balancing act in terms of having these upfront, frank conversations, but understanding the multitude of stakeholders that actually dovetail into that singular person that is potential at the tail end of their life. And therefore, acknowledging that will help you set up what best practice looks like, and then sort of dictate your terms from there.
Final question. If you wake up tomorrow and it's your turn to be a customer, of the aged care sector, what are the changes you'd like to see?
You'd be looking for a water slide or something.
I was going to say I'd want to be side
You want a
by
bar.
side.
Oh,
Emma wants a bar.
cute.
2-bedroom. Oh, look, I haven't given this a lot of thought. Hopefully it's a while away for me. I think I just had an experience at a hospital here in Brisbane, the birth of my first child.
Congrats.
And thank you. And it was fantastic in the way you could actually access meals at any time you wanted. So you could order lunch, morning tea, dinner, all on a screen in your room. So you had full control over when you wanted to have dinner, what you wanted to have for dinner. And I think that plus the ability to engage with people when I want to and go out and mingle with the other residents, but also have my own sort of privacy and ability to retreat when I need to.
You want to maintain the quality of life.
Quality of life, yeah.
My whole life, I've been part of communities. I'm part of a squash community. Love playing squash. That's so I'm transitioning into aged care nicely because I am trying to bring the average age down for the squash community. But I'm also part of a church, like from a Christian family. So I'd want to be part of that community. I have lots of work colleagues and school friends that are another part of my community. So I think I am going to aged care tomorrow. I've got heaps of grandkids. Don't have children yet, but got heaps of grandkids and they're around heaps. They come and visit me and I'm part of an aged care community that I get on with all the other residents. We have a good time. We play bingo together every Tuesday. And on Wednesday, we might play a bit of poker. And on Thursday, go and watch squash down the road. That for me is just bread and butter.
Bring the community into the care.
That's right. Because that's just been what I've cared for so long that I feel like at that tail end of my life, I still want to be part of a community or I'm bringing that community with me.
Oh,
Thanks,
so
gents.
much.
I hope this was time well spent.
Thank you.
Thanks for having us, guys.
Thanks for listening to this episode.
If this was time well spent for you, follow the podcast so you never miss an episode.
If you want to support us, leave a review and share it with someone in your network who might get value from it.
Finally, a thanks to our partners who make this possible. Painters, your design and construction partner.
And Optum Allied Health, your physiotherapy and allied health partner. You can find the links in the show notes.
Thank you for listening. We'll see you on the next episode.